Hello everyone, it's Dr. Trussell here, and we didn't quite finish the lecture in chapter 13, so I wanted to just put it in video form for you to have to complete your notes. We had an example in the outline that talks about how you are going to classify items. It says to indicate by letter the way in which each of the items listed below should be reported in a balance sheet, December 31st, 2016. It's either N, not reported, C, a current liability, L, long-term liability, or D, disclosure note only. Well, a customer advance, we know that that is a current liability. That's like unearned revenue and such. A non-committed line of credit, because you have not borrowed any money against it yet, it is just going to be disclosed. Commercial paper is considered a current liability. A note due on June 9th, 2017. Remember that our balance sheet date was December 31st, 2016. Since that's within a year, that is going to be disclosed as a current liability. Accounts payable, of course, are always current liabilities. A long-term bond that will be callable by the creditor in the upcoming year unless an existing violation is not corrected. There is a reasonable possibility that the violation will be corrected within the grace period. Okay, so the last part of it doesn't matter as much as the first part. That is the parentheses. The point is there was a violation, which would be like a debt covenant, that they were supposed to do something that they didn't do, so the creditor is now going to be callable, which means they can force the company to pay off the loan in the next year. Because of that, this is going to be classified as a current liability. Long-term bonds that are callable by the creditor in the upcoming year that are not expected to be called. It doesn't matter if they're expected to be called. If it's callable in the year, that means it's due on demand. Callable means due on demand, so the creditor can call up and say pay it. And so for that reason, it's a current liability. And then next is the estimated cost of quality assurance. Almost always that's your regular warranty, and we said in class that we almost always are going to accrue, even though that's a contingency. It almost always meets the probable and reasonably estimated criteria. Interest accrued on the note on December 31st, 2016. That is a current liability. Short-term bank loan to be paid with proceeds of the sale of common stock. Well, since common stock is long term, that's that refinancing thing that we talked about, and since that is going to be refinanced with something long term, then therefore that's going to be recorded as a long term liability at this point. A material gain contingent on a future event that appears extremely likely to occur in 3 months. Well, normally we don't do anything with gain contingencies. We said there's one exception, and that's if it's extremely likely, that is a high probability to occur, then we would disclose it. Now, we wouldn't record it, we would just disclose it. We wouldn't accrue it, that is. But that's an exception, remember. Number 12, unasserted assessment of penalty that probably will be asserted, in which case there would probably be a loss in 6 months. So there's a penalty that they're going to have to pay, maybe a fine for whatever reason, but because it's probable and they have a reasonable estimate, then that would be accrued as a current liability. Unasserted assessment of a penalty with a reasonable possibility of being asserted, in which case there would probably be a loss in 13 months. Okay, reasonable possibility. In this case, there probably would not just do anything at this point because of the penalty only being probable at that point, and now we're going into a year-long time period, so therefore we would probably do nothing with it. A determinable loss from a past event that is contingent on a future event that appears extremely likely to occur in 3 months. Okay, so we have, it's a contingent, and it says that in here, extremely likely to occur, and determinable means you have a reasonable estimate, therefore you would accrue that. The next thing we had to do in number 9 that we didn't get to is talking about the difference between US GAAP and IFRS related to current liabilities. In the book there's a separate section listing all the differences, but there were a few of them that I wanted to highlight for you. One is the definition of probable for contingencies. In IFRS they define probable as more likely than not, which means greater than 50%. But in US GAAP that is a lower threshold. In other words, probable means likely to occur, and so the probability is much higher than 50%. US GAAP does not give a number, but we do know it's higher than 50% because it says likely to occur. So basically it just means there's a lower threshold under IFRS for what they mean by probable. And accruing a contingency with a range for the reasonable estimate. In other words, let's say you're in a lawsuit and you think it's probable that you're going to lose the lawsuit, but you're not sure how much, but you have a reasonable estimate of, say, $1 million to $1.5 million. Okay, what do you do when you have that range? You are still going to accrue it because it's probable and you have a reasonable estimate, but which dollar amount are you going to accrue? So under IFRS, if the range is that all the numbers are equally likely, then under IFRS you would use the midpoint of the range. So in my example, $1 million to $1.5 million, the midpoint would be $1 million, $1.25 million. But under US GAAP they use the low end of the range, which would be $1 million. So it's a midpoint versus the low end versus the two systems. And valuation of current liabilities. We said under US GAAP that we're going to almost always use face value, but in IFRS it says if the effect of the time value of money is material, they require the liability to be stated at present value. And we said under US GAAP it's almost always at face value. So that's a pretty big difference on how we're valuing current liabilities on the balance sheet. And then finally, gain contingencies. We said under US GAAP, gain contingencies are never accrued. But under IFRS, gain contingencies are accrued if their future realization is virtually certain to occur. That is, really, really high probability, virtually certain. Then they would actually accrue a gain contingency. But US GAAP would never do that. Example 3 has several different situations involving the potential that is contingent liabilities. It says the following selected circumstances relate to pending lawsuits for Erica Inc. Erica's fiscal year ends December 31st. Financial statements are issued in March 2017. So the fiscal year ends December 31st, 2016. Financial statements are issued in March 2017, and they prepare their financial statements according to US GAAP. So we're supposed to indicate the amount of asset or liability that Erica would record. In the first circumstance, Erica is defending a lawsuit. Erica's management believes that the company is slightly worse than a 50-50 chance of eventually prevailing in court, and if it loses, the judgment will be $1 million. Remember the criteria to record a contingent liability. It has to be probable and you have to have a reasonable estimate. Under US GAAP, probable has a higher threshold than 50-50. IFRS, it was more than 50-50, but not US GAAP. So therefore, this would not meet the criteria of probable. It would probably fall under that reasonably possible. So therefore, you would not accrue it, but you would disclose it in a note. Eric is defending against a lawsuit. Management believes that it's probable that the company will lose in court. If it loses, the management believes the damages would fall anywhere in the range of $2 million to $4 million, with any damage in that range equally likely. Well, under US GAAP, so it's probable and you have a reasonable estimate. The reasonable estimate is a range. Under US GAAP, if there's a range, then you use the lower end of the range. So you would accrue, in that case, accrue a liability for the $2 million low point. Now, if this was IFRS, that would be the midpoint, which would be $3 million. Eric is defending against a lawsuit. Management believes it's probable that the company will lose. If it loses, management believes it'll eventually be $5 million with the present value of $3.5 million. Well, so it's probable and you have a reasonable estimate. The only question in this one is, do you use present value? Under US GAAP, we typically do not discount the estimated losses. So you would accrue a liability for $5 million. Eric is a plaintiff in a lawsuit. Management believes that it's probable the company eventually will prevail in court, that if it prevails, the judgment will be $1 million. Okay, winning the lawsuit means that this is a gain contingency, and gain contingencies are not disclosed. Now, if it's highly likely, really highly likely that they will get that $1 million, you could put that in a note. It's possible, again, only if it's highly likely that you would put that in a note. The plaintiff in a lawsuit, they believe it is virtually certain that the company eventually will prevail in court. If it prevails, the judgment would be $500,000. So that you look at that terminology, virtually certain. So because of that, that's a high likelihood. Even if it's a gain contingency, you would disclose it. Disclose it only under US GAAP. Now IFRS, because that virtually certain, they would be allowed to accrue it, but not under US GAAP. Just be a disclosure note. Last but not least is example 4. This is the last thing we didn't get to in class, and it's similar to the previous one we did. You just have to identify each of the items here on the left with the reporting method over here on the right. So we're going to say we're going to use one of these letters here: not reported, a current liability, a long-term liability, disclosure note only, or an asset. So commercial paper, we know that that is a current liability. Non-committed line of credit, we know that we disclose that only. Customer advance, we know that that's a current liability. Estimated quality assurance cost, we know that that is a current liability. Accounts payable is a current liability. Long-term bonds that will be callable by the creditor in the upcoming year unless an existing violation